Well, excellent, everybody. CJ Blankenship here. I hope everybody is having a great day. Thank you for joining us on this Friday afternoon in a time that is increasingly more optimistic, yet still full of many challenges for so many of our clients and our friends. And with that, I just want to say welcome. Look forward to spending some time talking about PPP and continuing sort of this series of what matters most matters more. Today, Paul Anglin, our tax director here at the firm, partner as well, my friend, is going to be joining us and talking about a couple of emerging issues. Karen Stevens, a lot of you know as our Goodlettsville office managing director, partner with the firm as well, is going to talk about some quiet provisions that are out there. And Ben Smith, our director of operations, is going to spend some time talking through a couple of the sort of operational and big picture provisions out there that we're dealing with right now as well. So thank you for joining us. I'm going to say a quick prayer as we get started. Lord, thank you for this time together today. Lord, we pray that you give us wisdom, that you give us direction. Lord, there are so many people hurting right now, and we praise you, Lord, because you are a God of comfort. Pray that you send comfort to those in need. In your name we pray. Amen. Wonderful. So my friend Ben is going to be running the slide deck. So as you hear me saying advance the slides, that is exactly what we're after. Thank you, Ben. This has been a verse that we've been really focused on, and that is just a continuation of taking precautions, definitely around one particular provision we're going to talk about today, the uncertainty provision. Taking precautions, as always, is prudent. All right, Ben. So quick sort of just some logistics here around the chat rules, very important. Chris Griffin, my longtime partner here at the firm, and Larry are going to be, Klum, are going to be proctoring the chat. Please, if you don't mind, ask as many questions as you like. Chris, if you don't mind, fire up the chat and go ahead and mention so people can see that pop up on their screen. Put anything you like in there, but if you don't mind, please refrain from answering questions. Make sure a Blankenship team member, whether it's Larry or Chris or Paul, thank you, Chris, and Ben, anyone that is represented here in these slides, Karen, will provide you with a quick and accurate answer, but that'll allow us to control the information if that's all right. On our website under news, lots of information. Continue to check in. If you need a copy of this presentation, shoot us an email as noted. V3 of the Relief Consulting Toolkit should be in your inbox. If not, feel free to shoot that to info@bcps.com. We sent that out right before the meeting. The master blueprint is part of that. We also, in the slide decks, have some references to that toolkit for materials as we go through. In case it's a little bit small on the screen, you can dig in. We've tried to cut it up to make it very visible. All right. Thank you, Ben. Let's advance. This is our standard language we're required to have, Circular 230 disclosure. Please don't rely on the information here as tax advice. Basically, we can sum this all up as talk to your CPA before you take any action. All right. So today, what's our objective? We want to continue what we've been talking about with digging in specifically to the PPP utilization and spending strategies. This is a huge emerging issue. So many folks that have the PPP loan at this point are asking lots of questions. And so we're going to dig into that along with an amazing blueprint that helps us balance liquidity with forgiveness. We're going to talk about some other provisions, and as always, really what this is meant to do is not to be, as just mentioned previously, to give you all the insight to just go full speed ahead. This is meant to be a baseline for a conversation with your CPA. So I mentioned earlier what we're talking about. Thank you very much, Ben. In the master blueprint, you've seen this. We're really digging in just to give you some perspective of where we are. We are really digging in to this green box down below here. We're talking about the PPP strategy, apply if qualify. We're going to talk about 75-25. We're digging into that, and of course some of the consolation prizes, particularly here. We're going to talk about the retention credit, the payroll tax deferral. We don't think is a great idea necessarily, but it is out there. We're going to talk about that. There might be an exception. And then some of these expanded tax provisions and particularly the paid leave credits and our post and promote strategy we've been talking about extensively with clients. All right, Ben. Excellent. So I'm actually going to let Ben kind of drive a little bit of our discussion here. This was our previous PPP blueprint. Larry, who is on the chat there, did a great job leading so much of our PPP effort. We're letting him take a little bit of a breather today. And we're going to talk a little bit about particularly the representation. This has been in the news. It's been a highlight. There is uncertainty around uncertainty, isn't there, Ben?
There sure is, CJ. Last time we talked, we talked about Pamplona for the bankers, running to the bulls. It was a mass rush on the banks to get after this PPP loan because it was such an attractive provision, and that proved true. Subsequent to that, and funding ran out. Congress reconvened and ultimately approved another more than $300 million into this program. But along with that has been a fair amount of negative media on misuses or larger companies that are consuming these funding. And to address that, the SBA and Treasury have issued some clarifications around the certification requirement. Certification that economic uncertainty makes the PPP loan necessary to support ongoing operations. And they have increased the penalties for those that misrepresent, falsely certify, and they've increased it all the way up to fines up to $1 million and 30 years in prison. Significant penalties for those that are potentially, for those that falsely, fraudulently certify this. And this was really aimed at the large employers, and a couple of very prominent examples of either publicly traded companies or large employers with private equity money or significant other resources. And so these clarifications were trying to tighten down on these misuses of the fund. As of yesterday, the Treasury has also announced that they're going to begin auditing or will review all PPP loans in excess of $2 million. So they're continuing to indicate that they're going to review loans and make sure that these conditions are true. Well, that creates a lot of concern or fear potentially in the marketplace. And so today's conversation is our views on how do we navigate in absence of guidance and an absence of certainty around these. They've issued no safe harbors, so there are no terms that you can look to say, I'm totally clear, because they've not issued any safe harbors. They have issued, and we'll talk about this later on, a May 7th payback day. So if you feel that you got a loan and that you can no longer certify the need for it, they are offering a pay it back by May 7, and you will have been deemed to have made your original representation in good faith. So on the left here, these first three lines are things that we would think about in helping answer the question, should I decertify? Should I pay back by May 7 any funds that I have received? And things that we would look to, again, Treasury, SBA, they're not asking us, but they're also not giving any safe harbors. So standing in the gap, here would be some things that we would consider. First is access to capital within the entity. Second is the unchanged ongoing operations. And the third would be the timing or depth of impact. For those out there who could say, yes to these things. Yes, I have access to capital within my entity. And yes, I anticipate an unchanged ongoing operation for the foreseen future. And yes, I have very little depth of impact now or later. If you say yes to those things, you really should be thinking about taking advantage of these decertification requirements. It would be increasingly difficult, likely, to justify the need for the loan if all of those things are true. To the extent that one or more of them are true, this becomes, really part of a conversation and a genuine consideration. This is all leading to the May 7 decertification opportunity. For those that, which we would anticipate is the significant majority of our clients, those that don't have access to capital or do anticipate a significant change in operations or have a significant depth of impact either now or later, there is cause to say that economic uncertainty makes this loan necessary to support my ongoing operations and the continued maintenance of my payroll, use of my capital, opportunities to sustain as an enterprise. For those that can continue to say, yes, this is me, we need to think through, well, that's true now, but what about what happens later? We don't know what's going to happen. And so for those that are concerned about the possibility of a swing of conditions, your opportunity is really to make sure you've got some good documentation, some good contemporaneous records about what is the situation of things today or at the time of your loan. These would be, evidenced by your economics, your financials, your forecast, your cost-cutting measures, status of your supply chain, your order board, various things. Hallmarks during the 8 weeks, things that we would look to that give you good confidence that this loan was necessary, losses in the period, use or tapping out your line of credit, accessing other forms of liquidity, significant top line or bottom line reductions, cost-cutting measures, letting go of people, shutdowns due to government regulations. Those would be hallmarks that you would want to make sure are getting captured for eventually needing to talk about your story. For those that then have all of those things and are in compliance, then the next question comes to, well, what happens if I can't spend all the money in compliance, meaning I can't spend more than 75% or more of the loan on my payroll costs? I think our view is that you just need to get to compliance. If you're not getting to compliance, it really does challenge the question above about whether the loan was necessary. Believing it is necessary, our view is that you just need to spend yourself to compliance on payroll costs, maintenance of your payroll, taking advantage of some of these strategies we're going to talk about later today. And from there, there's a number of other elements that are uncertain about, well, what happens if I don't? We don't know. We don't know. But it's going to be somewhere on the spectrum of you are going to have limited forgiveness potential, needing to repay the loan, perhaps immediately. We don't know whether this is going to happen on a pro rata or a cliff basis. So a lot of unknowns. What is good news, though, is that guidance will be coming before the 8 weeks are up, and the bill itself is very liberal. So CJ, why don't you add some commentary here?
You bet, Ben. Thank you so much for running through really candidly a complicated concept here, because there is not a lot of guidance. We have one side of the spectrum, just to summarize, where we are, if you have access to capital, publicly traded companies, we've all heard about this in the news, you should pay it back, no question. Then the other side of the spectrum, obviously, clear cut, should get the loan, should be getting all forgiveness, is, paused operations, revenue losses, plans to lay off, all these different, had to lay off, shut down, all these different things come together. And so somewhere in the middle is where, the vast majority of our clients, even with, tiered shutdown that a lot of clients are dealing with, but somewhere in the middle is where most folks are going to fall. And so what I think the big takeaway from this is contemporaneous substantiation. We want to make sure we have documentation around uncertainty, particularly, and the outcome. Even if the outcomes end up being very different than the uncertainty at the time that the certification was made, that is okay. No one has a crystal ball. It is important, though, as I've talked to clients about this, it's very important to substantiate it real time. That's minutes from board meetings. If you're a nonprofit or for-profit, LLC board meetings, make sure you're having those with the members in the LLC. You want to record this, make it official, and document not only any measures that have already been taken, but those that might also be coming in the future. For instance, if you had extreme backlog on contracts, if you're a contractor, and what happened over the last month and a half, well, all contracts basically ceased to transpire. You've just been working through backlog. So you would want to document that type of a condition and make sure you put that down in some corporate minutes, substantiate it, email communications internally to help basically substantiate the need aspect of things. And so the old saying, innocent until proven guilty. The good news is that the bill itself is very liberal. And the bill itself says if you qualify, if you retain employees, if you meet the safe harbor, the 75-25, all these things we talked about in the previous presentations, which I did not mention this earlier, it is on the website. Feel free to go to the same page, client Zoom events, that you registered for this potentially. It's out there, you can watch that. So all those normal things, those are de facto in the law itself. And so anything that would make it more stringent really is going to be through the regulatory process, which we have seen a lot of tightening of the screws throughout this process. So just keep those in mind. So Ben, with that, let's move on to this next slide about emerging issues. And this really just kind of continues that trend that Ben helped drive across the conceptual framework here of things are changing constantly. And so this decertification day, the May 7th, originally we called it the big payback, but we realized the big payback is actually the day before here in Middle Tennessee on a great nonprofit day. So many of our clients are nonprofits. Please support them. So decertification day is really what we want to refer to May 7th as. So if you can't meet those guidelines, it's clear that you have capital reserves. It's clear you're making more money than you've ever made, and it's been consistent in February, March, now April, heading into May. You're great example. You happen to do development for, I don't know, maybe video conferencing. There's not a lot of uncertainty for you during this season. Probably would not want to be able to make that certification or try to make that certification perfect. So constantly emerging issues around that. That is the biggest thing that we've been talking about. So we spent a lot of time on that. We're going to kind of move on from that framework because there's so many other things that are out there that are emerging as well. We got some great guidance. I saw some of the chats earlier around on the Schedule C file, on the K1 file. How does this affect? There's very specific guidelines that have been coming out really every couple of days. We had more guidance that hit last night. We'll talk about that down here at the bottom. And so as we talk through this guidance, it's very specific and it is ever materializing. Now, things that we don't have good guidance on, this next batch down here, are some things that are really important as we get into this PPP planning. Method to annualize the 100,000 exemption. So anybody more than 100,000 in wages, anything above that 100,000 isn't eligible for compliance costs or for forgiveness. And so, how are we going to measure that? Is it just going to be the flat 15,385 that was utilized in actually achieving the loan itself? Or is it going to be a payroll-specific application, 150 seconds, 250 seconds if you're a bi-weekly payroll, 1/24th if you're every 1st and 15th of the month, for instance? We don't know. Accrual versus cash implications. We have some folks who are accrual, some who are cash. Is it going to be a cash basis, is what we expect right now, a basis of when it clears the bank, when you make these payments? Is that going to be the baseline for the forgiveness calculations during the 8-week period? We feel pretty confident that's the answer, but we don't have any guidance. The full-time equivalent employee calculation, we got some great guidance around average monthly being the calculation for the base period. Remember, you have two different options for selecting the base period. That's the denominator. We talked about this extensively in the toolkit for the reduction in your forgiveness amount. That numerator, there's still some questions. How is that going to be calculated? Retirement benefit calculations. We're going to talk about these here in a bit. This is one of the items that are not limited to the 100,000 in the payroll costs. So there's, potential, a lot of ability for some movement there. Still waiting guidance. Payroll date versus date cash clear the bank. We already have multiple clients who are calling and saying, well, I got, I received my loan on this date, but which happened to be the same date as my payroll, but my cash came out the day before. So very interesting questions around what's going to happen with these payroll dates. Is there just going to be a guideline for this pro rata analysis? Is it based off when the cash clears? Is it based on the actual pay date? So hopefully we're going to get some guidance there. This approval versus origination versus funding dates. Lots of questions around this. Thus far, what we know is that the bill says when the funds are received. Origination is referenced many times in some of the regulations that have come out, which is to say the date that you sign the paperwork. Approval, as referenced, is usually the day an E-Trans number is assigned. So, you know, where do all these pieces fall in place? We feel like origination, the day you sign for the PPP loan, is really going to be the date for the 8 weeks. But if that happens to delay 2 or 3 or 4 days before you actually get the cash, there's a question out there around that. So no guidance on that as of yet. We are leaning towards origination. We feel like that is the strong basis. Any other limitations that could be issued? Just like the 75-25 rule, which was a really big rule. That was nowhere in the act, but that was part of the regulatory process. There's going to be a lot of this coming out over the course of the next couple of weeks. And a great example yesterday afternoon, these expenses that associated with forgiveness as being non-deductible. We assumed something like this was going to transpire because of the forgiveness being not taxable. Normal rules are when debt is forgiven as a taxable item. We were wondering, okay, is there going to be a reduction in tax attributes? That would be a normal tax theory that would accompany reduction in loan amounts and forgiveness of debt. Instead, they said, no, what's going to happen is these deductions, these expenses that arise to the forgiveness are just going to be non-deductible in the code section 265. So this was literally yesterday afternoon. So ongoing process, always new information coming out. And so in light of that, what we've done, Ben, if you don't mind advancing the slide, thank you, sir. We tried to put together a little bit of a strategy. I would refer to this almost like, candidly, like a honey hole. So a lot of you know my dad, Claude Blankenship, an amazing man. I'm sure he's on the chat right now, on the call right now. But I remember him telling me a story. So a lot of you may not know this. Dad grew up, candidly, just dirt poor, one of 12 children in West Virginia. Just literally back in the hollers of West Virginia. The stories I can't get into right now, but I remember him telling me as a young man, I mean, he really struggled. I mean, it was, to get food was, I mean, if it wasn't for welfare, I might not be here right now. And so, so praise the Lord, Dad got through that, and his story is an amazing one. But he, remember, as a young man, he told me the story about trying to find food and different little things like that, and the sweets were special, particularly like honey, for instance. So my dad still loves honey to this day. So he told me about bee lines. Everybody's heard of a bee line, and this is actually true. So what will happen is a bee, once it finishes getting its nectar from a flower, will take a bee line directly back to the nest. And so if you got on that bee line, you could follow the bee back to the honey hole, basically. So I like to refer to this kind of as the honey hole. We keep coming back to these concepts. We try to order them based on risk, just like if you're going to get honey out of the honey hole from the bees. You are always in danger, as Dad would say, and he had a lot of stories about getting stung and running away from the bees. So be careful about getting stung as you come to this honey hole, all these different PPP strategies. Also, in conjunction with this, what I want us to think about as we come to this honey hole and we look at these PPP strategies, we want to look at singles, doubles, and triples, which is to say, well, when I make this decision, what we're going to start with is the triples, right? You know, everybody who's familiar with baseball, obviously you want to get the home run, but next to it, pretty good to get on base. Getting triples really nice, right? You're looking at home base there. And so an idea with a single is, well, you just get forgiveness out of this. A double, you get forgiveness and either improve forgiveness reduction tests or it adds value to the business. Whereas a triple is all three, and that feels really good to us. You get forgiveness, you get improved reduction forgiveness tests, and add value to the business. And so as we move through these, we always want to make decisions based on, obviously, increasing risk. So least risky, obviously, is the most attractive. And then based on most benefits. So if you can get a triple that's in the conservative category, that feels really good. So Ben, with that, I want us to go ahead and move forward, and we're going to hit these 3 different columns. The first one here is dealing with payroll cost strategies potentially not capped at the annualized 100,000 limit. And this is broken into 2 categories, retirement benefits and health benefits. So just in the interest of time, as I'm going to kind of move through these relatively quickly, we've broken down these retirement benefits into the amount and timing. And so up here in the conservative area, and I'm just going to stick with retirement benefits and run through and then come back and hit the health benefits. But super conservative, continuing or restoring consistent with historical practice, any of these retirement benefits, and or making those contributions consistent with historical practice, whether that's matching and or basically profit sharing contributions. And so these are, if you've been doing it and you're continuing it, obviously very conservative. If you need to restore them, you cut them at the beginning of the pandemic, also very conservative. Whereas a little bit more moderate is maybe you're expensing these year-to-date accrued contributions at a higher than historical rate. Same thing with funding. So in instance, maybe you do something at the end of the year. Well, now you're going to do it in the middle of the year here, and you're going to layer up the whole first 6 months here in the 8-week testing period. Moderate, okay, it's what you've done historically. Moderately aggressive, you know, same rate, different timing. Aggressive, on the other hand, is to change that and increase it. Basically, you used to do a 3%, now you're going to do a 10%. And you're going to pop it down right there in that 8-week period, right? Feeling a little aggressive there. What we definitely would want to avoid is doing anything that is for future anticipated earnings. That does not feel right. If those earnings have not actually transpired, so let's just say I'm going to do a 10% match, I'm going to go ahead and fund it all today, not only for the first 6 months, let's say, of the year, if you're coming to the end of June based on your 8-week timing, but also go ahead and fund the next 6 months of the year. That doesn't feel very right. Okay. On the health concepts, restoring these normal health insurance payment practices, perfectly fine. You used to do 75%, you cut it to 50% because you're subject to the Affordable Care Act. Well, you're going to go back to 75%. That's fine. Moderate, maybe increasing cafeteria plan, HSA contributions, maybe increasing that employer portion of group health. You used to do 50, you're going to go to 75. You do this stuff for the entire year and it's pro rata, moderate, not too super aggressive. Whereas on the other hand, you come along and you basically just start increasing things arbitrarily or max funding during the 8-week period, that starts feeling a little bit aggressive. So that's kind of a spectrum here. And again, we're looking for singles, doubles, and triples, and we're moving from least aggressive to most aggressive. Obviously avoid some of these things down as we talked about. So let's go to the next little piece here in the honey hole. So payroll cost strategies capped at the annual 100,000 limit. So remember, we talked about earlier, 100,000 is the max amount that is considered when it comes to both compliance testing as well as forgiveness calculations. And so it's really important as we go through these things, we want to be able to make sure we're thinking about, and particularly in this phase, because of the 75% rule and the fact that both of the forgiveness reduction calculations come off of either one, decreasing employees during this period versus the baseline period, or number two, reducing pay more than 25% for those folks who make less than $100,000. And so what happens, this area right in here is very important for minimizing, as we get into the blueprint here in a second, the amount of those phase outs in the forgiveness. And so again, just moving through these, conservative, moderate, aggressive, on the wages front, you know, just continuing or restoring bonuses that have already been earned that are normally paid in this period, all very conservative. Anything that's normal or restoration of normal, perfectly fine. You know, moderate, you've got, you know, accrued PTO, paying that out during the real-time additional compensation to owners. And this is big. You know, I talked earlier, if you were reading through here, restoring owner compensation, conservative, that's fine. Consistent with prior year, that's good. Adding additional compensation, let's say that owner compensation happened to be below the 100,000, and now we're going to beef it up all the way to the 100,000 run rate during that period. Starts feeling a little bit more moderate. Paying earned commission bonuses at an earlier date. So I usually pay bonuses in September. I'm going to pay them here in May. Feels a little bit moderate, you know. Getting super aggressive down here, basically doing bonuses to the $100,000 run rate with no pre-existing bonus plans. Spot bonus, random compensation, you know, to get to that 15,385, for instance, or whatever fraction you add thereof. You know, prepaying bonuses for future employment dates. Hey, come work for me starting in July because I'm still shut down, but I'm going to go ahead and pay you a bonus right now today, even though you don't work here yet. These are things that get a little bit more aggressive. avoiding any type of increased wages to unrelated, to these related parties. So up there above, you mentioned about hiring people to do real work that are family members. It's aggressive because of the related party rules. But hiring people that are family members not to do real work, avoid at all costs. On the full-time equivalent, obviously conservative is pretty self-explanatory. Adding temporary full-time employees basically to replace these full-time employees and doing so with lower cost employees. I think it works actually, but a little bit more moderate. Trying to we need some more guidance on this June 30 that's out there for the magic rehire date. What I would encourage us to not consider doing is basically just trying to hire everybody late in the 8-week period, trying to meet that June 30 date, because I think it makes more sense to use an average monthly employee during the 8-week period. We'll find out what happens. But that feels really aggressive to me. So. And then down there in the avoidance, and Ben actually can't see the very bottom of that one right now and don't have the slide deck open on the other one. So hopefully some thank you very much. Prepaying those non-payroll costs. All right, this is a clear one. We've got some guidance around this. You pay 3 months worth of rent at the very end of your tail 8-week period, same with utilities, et cetera. That's just a no-go. Thank you, Ben. All right, so last column here, and then I want to get on to our blueprint, is the administration and strategies of PPP costs. This really has to do with timing and operation of things, okay? This is about changing from basically and let me just kind of start with the things that we know are really good here. Funds placed in a unique account, payroll tracking codes, new GL accounts for the PPP. All these are conservative, really best practice type concepts. Normal, continuing anything that's on a normal basis, letting those 8 weeks fall in the normal category, paying out those accrued wages during that period, that feels good. Anytime we start playing with this cadence, starts feeling a little bit different. Going to weekly and paying in arrears for wages that are earned, I think that's moderate, it's okay. Whereas on the other hand, we start getting down to these aggressive strategies, basically, paying an entire 8-week compensation in early payroll versus the normal run rate. That doesn't feel good. Relying anytime on these accelerated or delayed payroll payments to achieve the 75% payroll cost rule during the compliance period and or the forgiveness period, that feels a little aggressive. I don't want to rely on that in order to be able to meet these tests. Changing payroll frequencies to monthly or longer in anticipation of PPP funding or in forgiveness. So in other words, I think I'm going to get my PPP loan on the 1st. I thought that for the last 2 or 3 weeks. I decided I'm going to hold off on maybe a mid-month payroll and then pay a whole month basically on the 1st of May today so that I can make sure that fits in the 8-week period. This stuff starts feeling really aggressive. And then any time that we're prepaying wages that are not yet earned, doesn't feel very good at all. Okay, so with that, I want us to move on to, so again, these are the strategies, and these are really important. We spend a lot of time going through these because these strategies are what really drive all of the decision making here as we get into our blueprint. So Ben, if you don't mind, thank you, sir. Great. So this is our overarching PPP utilization strategy blueprint for liquidity and forgiveness. And conceptually, what we really want to talk about here is our is compliance. That is our first thing that we must achieve. And then after compliance, then we want to really focus on finding your unique place on the liquidity or forgiveness spectrum. Now, what's really important, you see those arrows right there in the middle on the right between preserve liquidity, those cycle arrows, and maximize forgiveness. It's important to think about these conceptually because where you are on the spectrum today or last week or a month ago is very different than where you might be next week or at the end of this month or at the end of June, at the end of the 8-week period. And so for every, this is a constant evaluation process. And that's really important as we were trying to, put together the conceptual framework for this. That was one of the things that we kept coming back to, is like, it just moves all these things. It is one big cycle as we go through this. And so we're really excited about this blueprint because it really summarizes, I think, the best operations for how to handle PPP, both forgiveness, compliance, and of course, liquidity, because we've been talking a lot for some businesses, forgiveness, this is in the toolkit. Larry and I have been talking about this for a long time. seeking 100% forgiveness generally is not going to be the right strategy for significantly effective businesses. So with that, I'd like us to go ahead and advance the slide, and I want to talk a little bit about compliance. Excellent. So compliance is really important because during the compliance period from 2/15 to 6/30, it's imperative that we have 75% of the loan proceeds being spent on payroll costs. Okay, so payroll costs, as well as in the up to, it has to be a minimum of 75. The other 25, it could be 100% payroll costs. But in addition to that, we have these other qualified costs: rent, interest on mortgage, utilities, etc. But we need to make sure all the funds are spent during this period. Now, coming back to our decertification day, as we talked about earlier, we spent a lot of time talking about this, but it's on here, it's on the graph here, on the blueprint. If you cannot, and I just stress it one last time, if it's clear you don't need these funds, be aware these are under scrutiny. And so this is our natural safe harbor day here to be able to be considered to have made this loan in good faith. And so in a worst case scenario payback, this is not the case for most of our clients, but there are some out there, some clients we've had conversations about where this might be the right decision here. So assuming we've done that, then we want to get down to the compliance line here. And so we say, okay, well, I'm going to meet 100% of loan amount during this period. Then I'm going to drop down. And now the first question I need to ask myself is these three different concepts around liquidity. And are my operations closed? Have I been losing money? Or cash reserves and flow pre-PPP were insufficient to fund my operations. I expect that to continue. I've undertaken layoffs and or cost-cutting measures. You know, if it's yes to any of these, you have a need, most likely, and again, these are, you know, continuing concepts, to preserve liquidity at this point in the journey. If, on the other hand, no is the answer to all these questions, most likely you're already in the maximize forgiveness category. So Ben, with that, we'll go to the next strategy, next page here. Because once we've answered these questions, then we get into the meat, and I love the way that this plays together, of how we actually handle PPP and what you need to do as a business owner. So the first thing is we want to make sure that we're calculating, first of all, the qualified payroll. These are projections of what I think I'm going to get during the next 8 weeks after my origination date, and those non-payroll costs, the rent-related things, those fixed costs, utilities, etc., for that 8-week period. So once you've calculated that, then what you're going to do is you're going to ask yourself these next three steps. The way that we kind of talk about this internally, you have your initial projection. We call that, it's like when we get a trial balance from a client. That's our PBC. Then we're going to go through a series of adjustments to get to a final answer. You know, 1, 2, 3 here, we might say is simultaneous with what we do internally at the accounting firm for adjusting journal entries. A lot of you receive those from us over the years. Maybe other journal entries that fall into different categories. Then we might have RJEs, which is reclassifying journal entries. And so what happens is we start with one scenario, and then as we go through these next 3 steps, we make these adjusting entries, then we have a new balance, and a new balance, and a new balance. Each time we come back to these PPP strategies, the honey hole we talked about earlier. Then I got to come back, I've got to recalculate, come back through these questions. And so these strategies, 1, 2, and 3, you know, once you calculate these non-payroll costs, what we want to do, and this is very important because of all the limitations in the 75% rule, determine if these payroll costs during the period are going to be greater than or equal to 3 times my non-payroll costs. So if the answer to that is yes, I move on. If it's no, then I need to get down into these strategies we just talked about earlier in those first 2 categories around the payroll costs, around my retirement benefits, around my health insurance, based again on triple, single, doubles. Again, something that gives me added benefit beyond forgiveness. I also get value out of it. We've talked a lot about trying to achieve value. And then also the best thing in there is it reduces my phase outs for my reduction in employees or my phase out for reduction in compensation. So if the answer is no, I go to the honey hole and I go to the PPP strategies. I select based on the ordering we've talked about. Then I come back and I recalculate. And then my answer now is yes, so I go to phase 2. So I've got this new balance here of what my projection is. And then I go to phase 2, which is on my payroll class plus those non-payroll costs together equal to or greater than the loan amount. If the answer is still no, then I want to go back to those PPP strategies. Consider what I can do to bring that number up to get all the way to that loan amount. Again, because what is on the table here is 100% forgiveness of the loan. Now, as I go all the way through this, so let's say I start getting back up to that, I have to always ask myself, continuously reevaluate, am I making the best decision for my business in this? Because now if you're getting triple benefits or double benefits, the answer is probably going to be yes. But on the other hand, if I'm in desperate need of liquidity, for instance, my operations still continue to be closed, I need to be able to preserve, I need to meet compliance, but I don't need to chase forgiveness because I need to preserve these funds in order to pay my fixed costs so that one, I can persevere through this, but then most importantly, come out successful in the back end. And so now, if I'm in this category number 2, I'm still okay on my liquidity. Feel like very optimistic operations are opening back up, but I'm going to select these strategies that provide incremental tangible or intangible value. That can be something that is as real as, hey, I'm bringing back an employee that can build an inventory item that I can then set on the shelf and sell at some point in the future. That's providing real value. That's tangible. And by the way, when I bring back that full-time employee, that decreases, my numerator goes up, that decreases my phase-out percentage for my reductions. Again, that's another benefit. That's a triple benefit right there. I get forgiveness, I get a reduction, and I get a valuable asset that now I can save in the future. Same for service companies, right? And so, but generally, as I go through that, and I'm looking at these in triples and singles and doubles, and I'm going from least risky to most risky, I don't want to go above the loan amount on that during phase number 2 here. And I go back through, recalculate, et cetera, I get all the way down, yes, now I'm in 3. Now my reductions are still limited, right? We talked about the reductions for the full-time equivalent test, as well as for the reduction in pay test. Now, if you're in a spot here where your reductions are still limiting the forgiveness amount, and you can implement a simple strategy from our, come back to the PPP strategies, where the forgiveness dollars achieved are greater than those dollars spent. Could I get forgiveness, for instance? And now at this point, I am decreasing those phase outs. And I want to add those strategies to the mix, make those adjustments, and come up with my new forgiveness dollar amount. And so what happens generally, we think most of our clients are going to fall in this ideal space on the liquidity forgiveness spectrum. Most folks aren't going to hit 100% forgiveness, generally speaking. And to be quite honest, if you do hit 100% forgiveness, it's kind of quite, I'm not going to say it's questionable, but you want to really make sure that you come back to that contemporaneous substantiation, et cetera. So I think that most of our clients are going to fall into 80 to 90% forgiveness. Some may end with 100. For some of our clients that are in complete shutdown operations, in, for instance, the hotel space or some of the food is starting to spin back up, praise the Lord, right now. But certain folks that are still shut down, they may be more in the 20, 30, 40% forgiveness category. And that's okay, because again, these loans are extremely attractive. It's important through this whole process, you're documenting these expenditures in real time. One of the things we talked about is put the funds out there, and then as you use them, basically have a expense report that summarizes those. Make sure you're keeping up with them real time, document, put those strategies together, and keep up with them. All right. So that's the meat of a lot of this PPP strategy. This is, again, this is not something we expect our clients to be able to just turn around and do 100% on their own. Now we do have a great calculator that's built in with these equivalent of 1, 2, 3, as I talked about earlier, AJEs, OJEs, RJEs, getting to that perfect balance. As you put these strategies together, that's a conversation we want to work with you. But you can go ahead and get started thinking about these things, getting these preliminary calculations together. We're here to help. But it is all about utilizing this conceptual framework, that baseline being these non-payroll costs, working your way through these 3 steps. And we believe that this is the recipe to find your unique place and know exactly where you need to be on the forgiveness spectrum. So with that, I want us to move on. Thank you so much, Ben. Paul, I'm going to hand it over to you here to talk a little bit about some consolation prize here. We talked about the employee retention credit. This is something that's out there that for those that didn't get a PPP loan or that are still struggling or maybe decide to decertify and pay that back, most likely decertification, paying it back, probably isn't the right thing if you're eligible for the employee retention credit, because it means you probably had some pretty significant operations. You can probably make that certification. This is really probably for folks that that really miss out on the PPP. So Paul, with that, let me hand it over to you, if you don't mind. Run us through this, sir.
Thank you, CJ. So the employee retention payroll credit, we talked about that a little bit on our call, but I think we'll get a little bit more deeper in the details today, as hopefully, as CJ said, if you were not eligible to certify and qualify for the PPP loan, that this employee retention credit might be an opportunity to help you through these troubled times. So just some highlights of the credit. It's looked at on a quarter-by-quarter basis, comparing the 2020 quarter to the prior year 19 quarter to determine if you're eligible in some instances. And you look at that from determining when you had a decline in sales. So if your sales in 2020 quarter are less than 50% of what they were in 19, you would be eligible for the retention credit. And then that would continue until your sales increase to 80% or more of prior year sales. So, you look at that on a quarter-by-quarter basis to determine if and when, how long the credit period would run. Barring an adjustment in revenues itself, if you have a COVID-19 limitation on your operations where you've been fully or partially sheltered, you may also qualify for this credit. So just because you don't qualify on the revenue side, you may qualify on the partial or fully reduced operations limit. And conversely, if you don't qualify, say your city or area has shut down, but you have teleworking advantages, so it didn't affect you, but you may then fall under the revenues. So either one of those would work. This credit, in addition to for-profit trades or businesses, also eligible for nonprofits. This does not apply to governments and to specifically self-employed individuals. And I'll caveat to say self-employed individuals that have payroll, that payroll would be eligible, but not the self-employed wages. And then as CJ mentioned, the recertification integration, thinking if you applied for a PPP loan, realized that you couldn't qualify or make compliance there, and you repaid all that back by May 7th, this might be an opportunity to get some money there. And so what is the credit? The credit is a $5,000 credit per employee, and that can depend on the size of your business. So why don't we go through the chart real fast and just look at some of these rules again. So again, the big thing, if you got the PPP loan, this is not for you. A lot of the overriding themes of all these laws is no double dipping. So if you are advantaged on one program, you can't take advantage of the other. With the IRS guidance that came out yesterday, as CJ just mentioned as well, you have forgiveness of loan, you can't also deduct those costs. And that's going to be the same with the credit. You can't double dip on a credit and a payroll cost. So keep that in mind as you're thinking about any of the provisions of the CARES Act. So again, if you didn't receive the PPP loan, you were in operations and you're a qualifying organization. Again, as we kind of hit on that, if you have revenues that have decreased by 50% that quarter, you're eligible to determine to take the credit. And then again, that would run until the quarter you have 80% or more of your prior year revenues. Then again, or if you've been partially or fully suspended. So you would be eligible for the credit on a quarterly basis. The overall limit for the annual amount is $5,000. So it's a little bit of a disconnect that you look at this on a quarterly basis, but it's an annual max on the credit. So once you determine if you're eligible for the credit, you have to determine the size of your business. So if you're under 100 full-time equivalents for 19, all of your employee wages would be eligible. So any employee you had, 20 employees at $5,000, that's a nice little benefit to have to help through these times. If you're over 100 full-time employee equivalents, only the wages for employees who are furloughed or have reduced hours would be eligible. So again, some limitations. This is really directed for very small businesses, but those that have larger businesses that have been very much affected by the COVID crisis would be eligible for a credit here as well. And then, like we said, the credit itself, it's up to $10,000 of wages. Wages also include health benefits. So hopefully you can get to the $10,000 per quarter, pretty easy. But then again, once it caps at $5,000, you're done for the year on that person. And it is on a person-by-person basis. Keep in mind that, as we just said, if you're taking like a work opportunity tax credit on individual or another credit, the same wages cannot apply for both credits. So there's a lot of devils in the details around this credit, but hopefully it would be advantageous to those that, again, did not take advantage of the PPP loan. CJ, any other comments on that?
No, that's excellent, Paul. It is this is a credit that's out here that is available and is very meaningful. You know, the issue really is, though, you have to really be negatively affected by this entire process. Would you agree with that, Paul?
Absolutely, and definitely if you're 50% less in revenues, I think that's easy to say you've been affected. So, you know, there's maybe a little bit more bright line test around this versus in the PPP certification, but definitely those that have been affected can take advantage of this.
That's right, and that's why we really do consider this a consolation prize, because if you are eligible for this, most likely you would be eligible for the PPP, and so good consolation prize for those who maybe banks couldn't get to it or some other issue popped up, because we're hearing a lot. I mean, this has been a hard process for getting PPP loans for lots of people. You know, I'm not going to get into all the stories. We're out of time here. I don't have time to do that, I should say. But it has been a hard process. So there is a consolation prize out there. That's why we're going to spend a little time working on this. So with that, I'd like us to move on to the FFCRA credits. And Ben's going to run with this one for a little bit, because internally and with lots of clients, we've been talking a lot about this post and promote strategy. I don't think we have our picture of Don King with his American flags, a great boxing promoter who's almost shameless in his promotion of boxing events. But we've been throwing that picture around internally and the clients. And I mean, that is really what I feel like this is, because this is a opportunity, candidly, to be able to find significant margin at the edges. So Ben, talk to us about our post and promote strategy and why this is important, and how, most importantly, we actually do this payroll process on these FFCRA, the Emergency Paid Sick Leave Act credits. We talked about this in depth. We're not getting into the details, just more on the operation today. And then the Expanded Family Medical Leave Act.
Yes. For those that, and you would have seen this in a previous presentation and also in the toolkit, for those that are covered employers and are able to maintain your revenues while having a temporary, while having employees on temporary leave, you have an opportunity to profit at the margin. For those in that category, we call it the post and promote, as CJ has just described. After you have determined yourself to be a covered employer, there are some setup things that are necessary. First, you must determine what is your policy related to intermittent leave. Traditional FMLA does not afford this on-off opportunity, but these CARES provisions, the FFCRA provisions do allow you to have on-off opportunities for leave called intermittent. And this is in fact even available on a partial day. So you as an employer would have the opportunity to allow your employees, if you can agree with them, to take part day increments. That said, as you'll see later in the slide, that just begins to exponentially increase the complexity of things. So we are recommending that you agree with your employees a one-day increment. What this allows for is them to take either the sick pay or the longer 50-day, up to 50-day expanded family medical leave in one-day increments, on and off, throughout as needed, as their schedule requires it. After you've determined your policy, then you must post it. And if you live in the category where this is an opportunity, post and promote. Then create 3 new payroll codes. The first one related to the sick leave, which is in categories 1 through 3, which is essentially I am sick. Then the second one for categories 4 through 6. This is related to the DOL structure. That's capped at $200 a day. Third one for the leave. All 3 of those need to be set up not subject to employer Social Security. They are subject to employer Medicare, but that gets recaptured in a credit. It is treated as normal wages for employees. don't forget to add on the health insurance. Chart here gives you some structure on how to think about calculating your preliminary and final payroll credits. And for sake of time, I think we'll just keep it moving.
Thank you so much, Ben. Absolutely. And the big thing, maybe that last point down there, reduce the deposits and take the credit. So just from a operational perspective, as you capture this real time, and this is a great benefit, especially for those who have children who are unable to telework, and this begins to be utilized. These are real dollars. Government is providing for this credit. It's clear that it's supposed to be taken, and it's a benefit. And so by posting it, promoting it, which is required, you have to post it, and then process those credits, reduce those payments. It picks up real cash flow from a liquidity standpoint and real dollars to the bottom line from a margin standpoint. So we keep talking about this because it's very important for you as an employer to drive these concepts with your employees if you are in the post and promote category. And as a self-employed, you're also eligible. So with that, we're going to go to our last conceptual concept here. We're going to probably go over by about 1 or 2 minutes, which is about what we waited to get started, which was good because we had about 75 people come on in that last minute or two. But with that, I'm going to have Karen cover 4 concepts. We're not going to dig into all these words here, but Karen's going to give us a highlight. These are some quiet provisions that are out there that I think are actually really big that people aren't talking a lot about. So Karen, do you mind digging into these for us?
Not at all. I'll do this entire slide in 60 seconds.
That's spectacular. I could never do that.
So quiet provisions. The first one there, the Main Street Lending Program, is a second loan vehicle in addition to the PPP program. And just because you've received PPP proceeds does not make you ineligible for these programs. So they are essentially for businesses that have been affected, of course, by the COVID pandemic, have less than 10,000 employees and $2.5 billion in annual revenues. So for those that might have been excluded from the PPP program, this could be an alternative to that. There's some restrictions on the use of funds, on compensation, and lots of details to be considered. There are certifications that have to be made, just like with the PPP program. And the rate here, these are 4-year loans at interest rates of about 2.5% to 4%, as opposed to the 1% for the PPP loan. Principal and interest is deferred for a year on these loans. And then there are some minimums in terms of the dollar amount of the loan and maximums as well tied to EBITDA. So a good option for maybe entities that are in a scale level that's a little bit above the PPP or weren't able to take advantage of the PPP, but those who received aren't excluded. The second category there being the federally backed mortgage deferrals. So the big important concepts here are forbearance and recasting. So 2 180-day payment forbearance periods for borrowers of any federally backed or owned mortgages. So HUD, VA, Freddie and Fannie. Forbearance provisions are different depending upon the type of the loan. And there are several examples that are out there, but the recasting allows potentially, if you meet certain provisions, extension of the loan terms up to 40 years. So this could be for anyone who finds themselves potentially in this category. Definitely reach out to your CPA to have a conversation about this. The third provision there is the HUD government-backed mortgages and multifamily. So there's 2 pieces to this. The first being that there's similar forbearance for those multifamily properties with 5 or more families. So the larger size properties, there are 3 30-day forbearance periods for a total of 120. And then there are also some tenant protections. But in addition to the multifamily units that are 5 or more families, any multifamily backed housing that has a federally backed mortgage for a 1 to 4 family property also may not, for a period of up to 120 days, initiate any legal action for non-payment. So you can't initiate any eviction proceedings, and you also cannot charge any penalties or interest related to non-payment. So for those of you who have rental properties out there, if they are government backed or HUD mortgages, which is 65% of all the mortgages, including Fannie and Freddie, you may want to take a look at these provisions just to make sure that you're not in violation of them. And then finally, the last one that's already been mentioned, I'm over my 60 seconds, is payroll tax deferral. And this is another provision for those who do not receive PPP forgiveness. There is an option out there to defer remittance of your Social Security taxes from March 26th all the way through taxes incurred March 26th through December 31st of 2020. And the remittance period would be 50% due a year from that, so December 31st, 2021, and the final balance due December 31st, 2022. However, we as a firm are not advising this in the majority of circumstances because if you fail for whatever reason to make those payments within that timely period, all of the significant trust fund and the failure to pay penalties, which are significant, would apply. So we think that this is probably a cautionary tale unless you talk specifically with your CPA and that's a strategy that you guys have decided on together. We're not recommending this one. So.
That's great, Karen. Thank you. That was very quick and a lot of information. You know, the big takeaway here is there are more provisions out there, and this is just a couple of the ones that we wanted to dig a little bit more into. But there are so many things out there you need to be talking to your CPA and your advisors about because it is wide and deep the amount of response that the government has had around all these things. So with that, Ben, I think we're going to take a quick gander at the master blueprint here. And just to, again, give perspective, please make sure to go check out the previous recordings out on the website under Client Zoom event. We dug into a couple of these provisions here today, but there's a lot more that are out there. Obviously, our toolkit is an amazing resource. Please, if you should have that in your email inbox. Feel free to share that with anybody that you know that could benefit from it because it is an amazing piece of work that has been built to help navigate these waters with not just information, but perspectives on how to handle these, whether it's ticking floor to house, all the blueprints around the actual information of these credits and the informations of how things function, but then most importantly, how to handle them most appropriately, whether it's post and comply and process the credits. It's finding your unique place on the liquidity forgiveness spectrum. These are amazing tools that are out here to try and help you as our client. One, have some baseline understanding, but then two, enjoy a personal conversation with your CPA to dig into this and help meet your needs during this most significant time. So with that, just some closing thoughts here. Would appreciate, obviously, as I mentioned earlier, taking the time to dig into finding your unique place on the spectrum. Talk to your CPA. Let us run those, 3 scenarios, 1, 2, 3, those adjusting trial balance conceptual framework of the increasing amount of the credit, the decreasing amount of the phase out, those doubles, those triples, those singles. How do they all fit together in order to get the best possible outcome? So for many of our clients, this truly is the lifeline that has been offered out there. Let's make sure that we grab that life ring and get pulled in as appropriate. Evaluate these strategies continuously in light of emerging issues. As we talked about today, there's so many things coming out literally about every 2 or 3 days. It's crazy to think that it's been 45 days of us digging into these. It just blows my mind. And here we are with just so much information that's been issued, and we will have that much more, particularly coming around the forgiveness process. There's more to planning than just the PPP. It's FFCRA, it's post and promote, it's the furlough concepts, it's our blueprint about taking care of the house. It's about planning for margin coming out of this. As we've, early on, we were hoping this was going to be a V-shaped situation. The consensus at this point is it's going to be a deep drop we've already experienced, but we're going to come out of it slow. We've already seen first quarter retraction is significant. Second and third quarter expected to continue to see GDP grossly decrease versus over last year periods. As we move forward, it's going to be hopefully a fourth quarter. We're hoping to see some increases coming out over the prior quarter, but still probably behind the year before. And then hopefully 2021, we're going to see us coming out of the recession in earnest. It is not going to be a V-shaped recovery. which means we need to plan for the long term, which is to say what matters most matters even more today. We appreciate you. We are grateful for the opportunity to serve every single one of you. Thank you for joining us today. Spend a little bit of time digging into this. Please call your CPA. Let's have these conversations. And with that, I just will say, may the Lord bless you, keep you, cause his face to shine upon you, and give you peace and rest during this time. Bless everybody. Take care. Thank you so much. Have a great weekend.